Hello, everyone. I think you can hear me and see the screen to check in for CPE. If someone wants to give me a thumbs up or chat, I guess you'd have to, yeah, chat me as a host that you can see the slides. Perfect. Thank you. We're going to wait just a couple minutes for everybody to get into the webinar here, and then we'll go ahead and get started. While you're waiting, you can check in for CPE. The QR code or the link are on the screen here. It should be the technically speaking event once you get in. So we'll give it a couple minutes for people to get logged on. Hear me typing probably as we wait for CPE check-in here. I think we're slowing down with people joining, so we'll probably go ahead and get started. So welcome, good morning, afternoon, early evening, depending upon where you're joining us from. Welcome to our first quarter, technically speaking, webinar. We're in, I believe, year 3 of hosting the quarterly event, so that's exciting. Happy 2025. I'm Jessica Boycourt, a director with KSM's Technical Accounting Advisory Services Group, which is a part of our Audit and Assurance Services Group, and I'm going to be leading us through the topics today. Before we get started, just a few housekeeping notes. The webinar is being recorded. That recording is available on KSM's website for on-demand viewing after the webinar. You'll also receive that on-demand webinar link in an email after the event that also has a link to a short survey. We do use those survey responses when planning upcoming webinars, so please take a few moments to complete that survey when you get it. If you have any questions during the webinar, please use the Q&A feature in Zoom. If you can't see that Q&A feature, I couldn't see it earlier, so it might be happening to you too. There is a more option where you can see the Q&A feature. We'll try to answer those as we go, but if you submit a question and we're not able to respond to it, we will contact you directly after the event. So as long as you've included your name and not marked that question as anonymous, we will contact you afterwards. The webinar does qualify for CPE, and we'll have this QR code back up again to check in for CPE. We use the Conference.io platform instead of polling questions, so log in using that QR code on the screen or navigate to that Conference.io web address in the first bullet point there. You can do this on your mobile device or on your computer. While using Conference.io, you'll first check in to the session. It's called Technically Speaking, and then you'll enter the code words that appear in the slides throughout the presentation. On each one of those code word slides, it will show you again how that works. You must attend this webinar for at least 75 minutes and enter at least 5 of the 6 code words into Conference.io to receive full credit. At the end of the session, please remember to check out. That way it notes that you're out of the webinar, and our certificates will be mailed from our learning management system within the next few weeks. If you have any questions about that, we do have someone from our team on today. Please put those questions either chat with the host and panelist or in Q&A. The slides will also be available for download after the event, and we'll have the link to the slides in the chat today so that you could download them now if you wish to follow along. So now we're going to move into our presentations. There's 4 of us today on the call. We're going to be talking about technology-driven audits, lease accounting, engagement scenarios, and our kind of running topic for the accounting standards update. We're going to start out today with a code word. I think this is great because it gets everyone into Conferences.io before we start the material and make sure we're entering code words correctly. So code word number 1 is 425. There's a nice visual on the screen with where you would select code word to enter that code word in for CPE. I'm going to leave this up just for a second so everybody can get that. Again, code word number 1 is 425. Okay, so our session objectives for today, number 1 is to understand the impact of artificial intelligence and technology on audit and accounting. To clarify some ongoing impacts of lease accounting guidance in ASC 842 leases. Fun fact, our very first Technically Speaking back in 2002 was all about leases. So we are excited to be 3 years later still presenting about leases. Third, being able to identify the types of engagements that KSM provides and maybe determine what scenario would be best for you to fit your needs or your requirements. And lastly, being able to discuss the recent accounting standards updates and any current projects by key standard setting bodies. So first, we're going to start with the artificial intelligence and impact of technology section. Today, you'll notice we have Ben Krim, a manager in our audit services group. He's a member of our technical accounting services group as well. He's going to be stepping in today for Justin Hayes. Justin is out sick. I have 2 kids, so I know that it's been bad this year. So hopefully everyone on the call is well, but he's out. So thankfully, Ben was able to step in last minute and help out today with this. He's a manager in our technical accounting advisory services group and serves as a resource and technical expert in helping KSM clients and engagement teams identify and better understand complex accounting and auditing topics. He does research for technical accounting topics, helps interpret new accounting and professional standards, and advises KSM teams and clients on appropriate solutions to their complicated accounting matters. So I'm going to turn it over to Ben Krim to talk about the audit of the future.
Thank you, Jessica. So 2 objectives today for these quick 50 minutes I have with you. One is identifying some of the top technologies that have emerged and are emerging quite quickly and are actively being implemented into our financial world. And 2 is just discuss how these technologies are impacting auditing. So these technologies are the ones that we kind of identified to focus on. No conversation about technology going forward for, I think, a very long time is not going to mention AI. It is being, the conference I attended last summer, at the vendor hall, every single vendor was mentioning AI, whether it was actually implemented into their software or not. So a little bit of a buzzword being thrown around, but it is the AI platforms that I have tested have been have really changed how I go about my day-to-day work already. And I'm really looking forward to them being properly implemented into the softwares that we use every day. So there's generative AI, applied AI. Then I'm going to talk about cloud computing, which I think we're all a little familiar with, and just data extraction and analysis and some of the changes that we're seeing in all of these technologies that are happening. So generative AI is just the concept of artificial intelligence that allows us to take large amounts of data and input it into an AI platform that is able to then automatically take that unstructured data and turn it into a more meaningful output for us. This can, there are some fun applications where within a large language model like ChatGPT, you're able to just type in plain English, I want you to generate an image of a monkey in a tree in a Santa outfit, and it's going to do something like that. But there's also very good applications to our accounting and auditing world where you can take raw financial information, raw general ledger data, and really get an AI model to give you really meaningful insights into that data, and those very quickly too. I mean, the speed at which it's able to automate and augment this data is the biggest, one of the biggest benefits, because it's really going to accelerate the pace that we're able to do some of the analysis that we've always done, but without having to do nearly as much manual data manipulation. A lot of time historically has been spent on getting reports from the client, and then manipulating that manually to work with our existing softwares. And AI is able to better take that data and manipulate it very quickly. So some examples of that technology: ChatGPT is great. If you haven't experimented with it, I would definitely recommend giving it a try. Be cautious with what you're putting in there, but you can really get insights into how some of these AI models are able to summarize documents very accurately and very quickly, draft reports, and generate insights into data very quickly. I think clients are going to notice, as we're able to use AI more, we're going to have overall fewer audit requests, hopefully, just because we'll be able to take raw data rather than having to ask for individual reports on every single piece of the general ledger. Applied AI is just the concept of applying artificial intelligence in a practical way. So using artificial intelligence to solve real world problems. We can use AI to automate a lot of activities. A lot of the manual data manipulation that we were having to do is very easily able to be automated by AI, and really enhance the capabilities of our current softwares and improve our decision making. One of the biggest benefits of AI that the platforms that I've been using is just, you don't have to know the technical computer language, or you don't have to know complex Excel formulas. You can just upload your raw data and tell it kind of in plain English what kind of output you want. And then you can correct it. You can say, oh, I actually know I need it to look like this. And it does it on the fly very quickly. And that's really going to enable a lot more people, enable accessibility when it comes to using some of what we've thought of as very complex softwares in the past. These applications that are listed as examples are just a few that are using AI, but there's endless AI now. It's like I said, it looks like AI is being implemented into a lot of the softwares that are being used by a lot of the financial softwares. The TensorFlow is a platform that really allows for good fraud detection, risk modeling, and analytics. Just very quickly, AI is able to look at such large data sets and do meaningful analysis. It's able to let us focus us in on where there is high risk, and where there are unusual transactions, and where things don't reconcile, or things are maybe in the wrong place. It's able to do that very quickly and allow the auditor to target those risk areas. Cloud computing, I think, cloud computing, we've always heard about the cloud, and it's been around for a while now, but it's been getting very rapidly. It's been evolving, and it's become more prevalent. The benefits, cloud computing is just the concept of, rather than having your local network, you are connecting to a large data center where your data is being hosted remotely. But because of that, you have access to much more computing power. And really, the onset of cloud computing is what has enabled artificial intelligence to be so accessible as well. Our laptops cannot run ChatGPT locally. They can't handle the processing power that is needed. But now I can log into ChatGPT on my iPhone, And because it's connected to a cloud platform, it's able to use the computing power of a cloud service. And as increasingly companies move their financial platform into the cloud, the benefits you're going to see there are mainly speed and reduced processing times, as long as you've got a good internet connection, which by now, a lot, if you're in a city, a lot of fiber networks, you're able to, you have access to more computing power. So when you ask to run a report, it's going to take a lot less time because those cloud platforms are going to be able to, they can allow you to access more processing power when you need it, versus the limited processing power you have locally if you're just have a server in your IT room. So really the biggest thing mention of cloud computing is just that it is what is really responsible for the fact that we've seen AI emerge so quickly and become so accessible to everyone, because everyone is logging into a cloud computing platform when they're using AI. And the benefits are going to be speed and computing power and just the capabilities that we've never had before when it comes to computing and analyzing data. The data extraction and advance and analysis is, we've always done data extraction and we've always done analysis, but these platforms, that the softwares that we're using are changing, evolving, and they're changing very rapidly, and they're implementing AI, and they're also implementing the cloud. One of the really cool things is a lot of them are allowing now for more, as our clients have moved into the cloud, we're able to connect to their systems more, which may be a little scary, but allows us as auditors to, we don't have to have as much back and forth about our audit requests or any of our requests, because we can get the data we need, that our platform needs, without having to have back and forth about, oh, I need this report in order to test this section. Oh, it wasn't quite, I need it in a very specific manner. Oh, I need it in a very specific format. If we're able to have a live connection now because of the cloud, that kind of data extraction can be done automatically. The ability to have access to such large amount of data is allowing us to really perform better analytics, analyze all of the transactions for inconsistencies and look for trends, really cut out a lot of that manual data preparation that we had before. Before, even as little as 5 years ago, 10 years ago, we had these softwares that allow us to do fraud detection. But first, we had to get the data from the client, and a lot of those softwares required it to be in a very specific format. And in order, you had like maybe 5 or 6 different tests, and for each test, you needed a different data format. So a lot of time was spent running and communicating with the client, getting the right format and getting the right report. And now, because of some of the live linking, we're able to eliminate a lot of that back and forth. And I say now, but it's also, these are being implemented as currently. So this is just evolving, kind of what we're going to see happening in the near future here. Some of the examples, one, we've used Data Snipper for several years now. It is a very powerful tool. I really wish when I was a first-year staff I had access to this tool. It is a tool that allows, it is kind of an AI tool that reads the supporting documents that the client has provided. So if I have a list of invoices, invoice numbers, and dollar amounts, and my client gives me a PDF with 200 invoices in it, Data Snipper in literally less than a minute is able to match up all of the supporting documentation to my listing. And then I can just click in my individual cell and see, okay, yes, this ties out. It takes me to that exact page where it is highlighted the dollar amount and the invoice number. So just immediately cuts out so much manual process of me having to, if I have 25 selections, having to search through, we've always had optical character recognition, so it hasn't been completely inefficient, but it's getting better and better and faster. And these tools that are audit, Trulion is a tool that automates kind of some of the just accounting, in that it is able to take your actual contracts, analyze them, and then do the accounting for you. So all very automated lease contracts, update all your leases, upload them, and it's going to read them and give you the lease accounting that you need. Same with revenue recognition. It analyzes your contracts, your customer contracts, and gives you the revenue recognition you need. So a lot of this is being automated very quickly, and it's great to see these technologies emerging. Inflow is an audit platform. It's what we use to conduct in our audits. And we're moving towards using it for all of our audits in the next busy season for us. And it really changes because it allows us to use these kind of AI tools and other tools, and that it's automating a lot of what we've had to do before manually. It's able to do that because it's taking advantage of the fact that it's in the cloud, and now it's able to process this large amount of data. But by directly connecting or doing a large data extract from our clients' financial systems, it's going to automatically, identify a lot of the risks that we need to audit and identify trends and unusual transactions and do like a lot of the fraud testing that's required. So hopefully, just because of the improvements that have been made in this data extraction and in analysis, we'll see fewer requests because we'll be able to get just one large data extract, and overall faster turnaround time because a lot of the manual processes have been automated. We have a code word/number 443. Let's just stay on that for just a second here. The last thing I want to cover just in general, it's going to encapsulate some of the things we've talked about, is just innovating within the audit. So what you're going to, as a client, see changing. One thing is definitely just the nature of audit requests. This is not going to happen overnight, but over time, we will be, as we adopt these systems, we're using Inflow on a number of engagements this busy season, and then we'll be using Inflow in the future. Our benefits plan practice is looking at a very powerful tool that helps conduct a lot of the required testing for 401k plans. By just doing a large data extract from the payroll system, it's literally able to just automate the testing at almost a full coverage level. So rather than doing even a sample, it's able to look at all the payroll data at once and tell the auditor where there might be issues. So what you're going to see as a client is that the audit requests will be changing because we're going to be asking for full general ledger data extracts, or one of the easier options is kind of that automatic data connection that the more advanced cloud computing financial systems enable. A lot of these systems, I say advanced, even like QuickBooks, the online even has kind of an auditor access and says, here's common reports your auditor needs, or we'll link up to these specific systems, Inflow included, and give us, and that way our audit platform is able to just automatically extract what it needs from your accounting system, rather than us having to have back and forth about audit requests, other than the general like support stuff. But a lot of the requests that have historically been having the client run a very specific report. So fewer document submissions and easier data sharing is in the very near future. When it comes to auditing itself, the auditing standards have been very supportive of the embracing this technology. Just as recently as last year, the auditing standard about risk assessment was revised to really embrace some of these tools. And the AICPA has released a lot of guidance on applying technology to audits and telling auditors, we want you to be using technology in these ways. They want to show that they're embracing technology and give guidance on how to use it. There was a revision to the risk assessment standard, pardon me, that really told auditors to focus on identifying risks and testing those risks. So gone are the days of kind of beating up the overall balance sheet. And instead, we are going to be focusing on using technology to identify risky transactions and test those transactions. So you're going to see our requests change from what we've requested in the past because A, we're going to be using different technologies, and B, the auditing standards have been updated to tell the auditors, no, you need to be doing this. You need to be testing revenues in this way. So you need to be testing revenues more because we now have the technology to be able to look at, you can do a large data extract and look at all of it. So they don't want necessarily us doing, we're still going to be doing sampling at some level, but they're saying you should still be doing an analysis at 100%. And so you're going to see that's going to be a change. And then also just we'll be able to provide a lot more insightful feedback on your business to help your business, identify risks and opportunities also, because we'll have access to more data and some of these tools that are really giving us a lot more insight into your financials. That's all I have for today, just kind of an overview, nothing too detailed. But if you have any questions about these applications or their use, you can feel free to message me.
Perfect. Thank you, Ben. And again, thank you for covering for Justin today on very short notice. We are lucky to have so many people that are up to speed on these technologies that it was easy to find a replacement. So we're gonna move on. Next, I get to walk us through the remainder of some lease accounting reminders that we actually started going through in our November event. If you were not on for the November event, you can see the first portion of this lease accounting refresher on demand on the KSM website. So lease accounting refresher, take two. Again, Jessica Boycourt. I am a director in our technical accounting services group. I provide technical guidance to clients and engagement teams to help better identify issues and understand complex accounting topics. My role primarily focuses on compliance measures in the firm, such as internal quality reviews, technical training, and resource development. So again, a short list of objectives today, because we're covering kind of the second half of what we weren't able to cover in November. So we're going to discuss some additional related party lease considerations and that accounting. And then secondly, talking through appropriate accounting for a lease modification. Both of these topics actually have been covered in the past. Lease modifications was covered in our May of 2023 webinar. So if you need additional details as well about that, you can always review that presentation or reach out to us directly, because we do continue to get questions pretty regularly on these two topics. I actually was talking with a colleague this morning about the related party lease considerations that we're going to talk about now. So please note that these concepts could apply to third-party arrangements. So we just typically see them when we're looking at related party leases. So we're referring to these as kind of related party lease considerations. Also, something to remember is that a related party is not always also an entity under common control. So the FASB had issued some relief for entities under common control as it related to ASC 842 and lease guidance there. And that was ASU 2023-01. There were a couple of items in that literature that may not always be applicable to every related party lease, because those only applied to entities under common control, which is why we're seeing some of these issues. So the first one is related to unwritten lease agreements. Now, if you were an entity under common control and were able to adopt ASU 2023-01, it allowed you to write down the lease, with what those terms were and just use that for those agreements and even let it be retrospectively applicable. But if that's not, either was not adopted or it's not a lease with an entity under common control, then the accounting for the lease must be based on legally enforceable terms and conditions in that lease. Now, because lease agreements do not have to be written, it's really interesting to determine what the legally enforceable terms and conditions are in an unwritten lease agreement. It's incorrect to conclude that there are no legally enforceable terms and conditions just because there is no written agreement. And that determination of legal enforceability has to come from legal counsel. So this is somewhere where as accountants, as auditors, or even as you're in practice as an accountant, you're not able to necessarily make that determination because it is a legal concept. You also, at the same time, you're thinking about, well, what a lease agreement do I have with a related party that may not be written, and what are the terms and conditions here, is thinking about implied enforceable rights to determine what the lease term is. And this would be things such as, anything that's unwritten, but it's like, well, we know we're going to renew it every month or every year because let's say, our related party is the one that built the building for us to operate out of and we're leasing it from them. Even if you had set up maybe a 1-year lease for that, it's kind of implied that you're going to be renewing that every year. That's the concept of kind of an implied renewal option or an implied non-cancelable period, just based on the fact that your operations would severely be impacted in that scenario. Something else that plays into the lease term is the concept of a unilateral termination option. And this is with that legal enforceability. So per the standards, a lease is no longer enforceable when both the lessee and the lessor each have the right to terminate without permission from the other party with no more than an insignificant penalty. We do see a lot of times that unilateral termination right is in there, but what hangs people up and causes some issues with the accounting is whether or not there's a more than insignificant penalty. And part of this is because penalty is really broadly defined and it's not limited just to financial penalties. It could include any disbursement of cash, performance of additional services, assumption of a liability, foregoing an economic benefit. So maybe a common example here would be if there are leasehold improvements, then you would have to give those up if you walked out of the lease, or if there was any other economic detriment. So maybe that includes the biggest things we would see are if there's higher rent somewhere else, or if it would cause operational disruptions. So thinking about whether or not there's this insignificant penalty can change the fact of that, or can change the timing of that non-cancelable period of when the lease would actually be considered enforceable. You would have to consider and kind of reassess for changes in circumstances on this, but this is where I think we've seen kind of more back and forth with what is the term of the lease. Generally, if an entity has significant leasehold improvements, or if the market rents are significantly higher than their current lease cost, then a lease is not going to be deemed to have that insignificant penalty. It would be considered significant just because you'd be abandoning those leasehold improvements, or if you decided to lease with a non-related party, you would have a much higher rent expense. So you would need to consider all of those penalties to determine if a lease is or is not enforceable. Cancel at any time, or so-called, in quotes, month-to-month leases. We see this a lot. This was the conversation I actually had this morning. But is anything really month-to-month or cancel at any time? And again, it comes back to the two concepts we just talked about with what is that true cancelable period and when can you cancel, and what is the impact of being able to cancel that. They actually had put out some guidance, and I do believe the Center for Plain English Accounting of the AICPA put out a paper on this as well. So there's more information available online about this, that you have to look at whether those options to terminate, if they're reasonably certain not to exercise it or to exercise it. For real estate leases, they generally say that non-cancelable period has to be at least 1 day. Just because you're not going to be able to like pick up and move in 1 day. Generally, that lease term is included. So if you're going to say, well, my non-cancel lease period is 1 day here in the first part of the equation, you still have to look at these extensions and terminations and that you're reasonably certain to exercise. And that reasonably certain is a pretty high degree of confidence as well that you're going to stay there. It's greater than probable. Because you have to include that, if you're thinking about a real estate lease specifically, moving from one location to a new location typically is not a 1 day, 2 day, 1 week, maybe not even 1 month thing. I know that, it's generally weeks or months in advance. So figuring out what that result, even if it's cancel at any time, what is that true time period where you're going to have to stay in your lease to be able to move. A lot of leases that we see will have a 30-day cancellation clause. So thinking about what that non-cancelable period is really the remainder of that 30 days, but you could also have a term longer than that based on what they're reasonably certain to exercise in the future in order to actually facilitate moving, or maybe it's a piece of equipment that you're going to have to transfer use or whatever. So it may not be truly month to month when you start looking at the actual concepts in ASC 842. Code word number 3 is up on the screen. I'm going to give everyone a break before we get into lease modifications to type in a code word. Code word number 3 is 520. Lease modifications is something that when the lease standard first came out, no one was really thinking about, because in the first year of adoption, you weren't dealing with lease modifications because they were all new leases with 842. But over the last 2 years, we've seen this concept come up kind of more and more. So again, code word number 3 is 520. So as I mentioned, we covered this in detail, lease modifications in May of 2023. Even at that point, people were really maybe in the first year of having a lease modification on an existing lease. And so this presentation today isn't intended to be more of a summary of some of the key terms to maybe help clear the water, if you will, with lease modifications. So we're going to be on this slide for a minute, so hang with me. But first is a lease termination. This actually in the ASC 842 is technically a type of lease modification, and you'll see that in a couple of slides. But I think the biggest thing here to remember is if you have a lease termination, that's going to be an agreed upon change in the contract between the lessor and the lessee in which there's no more right of use asset or liability remaining. That's going to result immediately in a gain or loss charge to the income statement. That will be different than any of the lease modifications that we're talking about there. So this is where I think the big difference is between if you have a termination versus determining what's the modification and what type of modification. That's kind of the easy button, if you will. The second one is a lease modification. These also require an agreed upon change in the contract between the lessee and the lessor. So it's something that has to be a agreed upon change in the actual contract, same as the lease termination, but you're not fully terminating, something is just changing. We'll go into more details on what are the types of lease modifications and the accounting for those. But prior to that, there's two more terms that they threw in the new guidance that I think are where we start to see additional confusion. The first one is a lease reassessment. This is required when there's a reassessment event, which would not necessarily involve renegotiation of a contract with the lessor, but it could. But it could just be when there's a change in the lessee's facts, assumptions, or other circumstances related to that lease. So, we just talked about those termination options, or if you're reasonably certain to, take some kind of renewal option, or how long you're going to stay in that. If you changed, there was some significant event or change in circumstances that change your determination there, you'd have to reassess your lease to make sure the lease term is still at the same time. So you can have a lease reassessment event without having a lease modification that requires that change in contract. We do see this happening, and it's a little bit different accounting than as what your lease modification is. However, those reassessment decisions could be a result of a lease modification as well. This is where it starts getting unclear. The last term is a lease remeasurement. And this is where you're actually, generally with a lessee, is going to be required to remeasure their lease liability. And that would be either because of a reassessment event, which we just talked about, or because of a lease modification. So you could end up remeasuring your lease based on either of the two buckets, lease modification or lease reassessment. A lessor is not going to be required to remeasure a lease unless there is an actual change to the contract. So lessors don't really have that concept of lease reassessment. But the reason for your lease remeasurement is going to help determine the accounting. It's going to either put you in lease modification or lease reassessment. This is where I think if you were drawing a chart of like, if then choose your own adventure, things start to get muddy. All of the terms are very similar and do get used interchangeably when we're speaking about leases, but really they are all distinct things. So I think having this terminology and kind of thinking about what bucket we're actually in helps determine where we go next. So as I mentioned earlier, lease termination, you're going to have a gain or loss immediately to the income statement. No more right of use, asset, and lease liability. A modification or a reassessment could both result in lease remeasurement, but the type of the event is going to dictate how you account for that. A lease modification is going to be required to have a change in the contract with the lessee and the lessor. Lease reassessment could have that, but also could be because the facts and circumstances from just the lessee's perspective have changed. There could be other events throughout the lease term which require you to remeasure without having that modification event or lease reassessment event. But a lot of those are, more specific scenarios. So we would just, consult your advisor about what those situations would be. I would say in general, if you have a lease modification, you're probably going to want to reach out to us just to make sure, or to your advisor, just to make sure that we're in the right bucket. So if we're looking at just bucket 2 from the prior slide, a lease modification definition, we talked about this actual change in the terms and conditions of the contract that change the scope or consideration for the lease. So there's 2 big types of modifications. One is where the change is giving the lessee additional rights that were not included in the new or in the original lease. Or it extends or reduces the term of that original lease, or it changes the consideration in the contract. The second option here is really mostly that lease termination from the prior slide, but there is a concept of partial termination of a lease, but that is really you'd either fully terminate your lease or you reduce that right to use to some of the assets. Those are going to be the areas where you have a gain or loss recorded. The biggest issue here is when you're in this type 1 of the 2 type of lease modifications in terms of how you get to proper accounting, because that's where you first have to determine, like, okay, we have additional rights, we're extending or reducing a term. Do we have one modified contract or 2 separate contracts? If you have, and this is the same for lessees and lessors, if you have 2 contracts, the original contract and the new contract, you always have to make sure first that they contain a lease still. But if it's 2 contracts, the separate new contract would be evaluated for whether it contains a lease. And then that new contract is accounted for just like any other lease and recorded on the commencement date. The conditions for it to be a new lease would be 1, that the modification grants the lessee an additional right of use that's not at all mentioned in the original lease, and that the lease payments for that additional right of use are consistent with the standalone price for that additional right of use, including any other adjustments that are unique to the contract. So if there's other, non-lease, components, and there in this scenario, you're basically saying this has changed enough and we have 2 totally separate leases. The original lease, you just keep accounting for it like you would, and you start with a new second lease. This, again, I think is a little bit more clear of the accounting because you're just doing ASC 842 in 2 buckets. The issue here is when you end up with one modified contract. I don't want to say the issue, but the more complicated accounting is when you end up with one modified contract. But you'll see it took us 4 steps to get to where we're determining that we have one modified contract. That one modified contract, again, always start out with whether it contains a lease or not. If it does, reconsider first your lease classification. Is it finance or is it operating? Then you're going to get to lease remeasurement. I tried to highlight the terminology here, but you remeasure the lease liability and adjust your right of use asset. This is the example that we're going to go through today, walks through this. And we'll provide the example also after the event, but you could end up with additional lease components in this scenario as well. But that's where the accounting kind of gets fun because you got to figure out how to remeasure and record this. So I know this seems a little bit backwards because of how the slide is showing up, but bear with me. So you're remeasuring the lease, adjusting the right of use asset, and then you'll notice we also have to do a reassessment, a lease reassessment. So you'll see here how we got from that terminology sheet into modification accounting requiring a remeasurement and reassessment of basically the concepts that fall into your lease term and accounting for that. You adjust the right of use asset in an amount that's equal to the adjustment to the lease liability. So you're going to start with the remeasurement of the lease liability and adjust the right of use asset accordingly. Do not recognize a gain or loss as a result of the modification unless the carrying amount of your right of use asset is reduced to 0. We have to make the entries balance, and so then you would potentially record that remeasurement and hitting net income at that point. Example, because we all, hopefully it's not too much to go through this example. Let me pull it up here. Again, we'll provide this. I think that'll be a little bit more clear. It's hard when you're just reading the facts versus when you're actually doing it, but one that grants an additional right of use. So you can see the facts here where we're running through on year 6. They agree to modify the contract. So we know that it's not just a reassessment event or a remeasurement event because they've actually changed the contract and it's including an additional right of use and it's revising the payments. So as we talked about, we have to determine if there's a new separate contract or one single modified contract, and there were two considerations for that. Here we walk through, well, it's not just because of this because this amount changed enough that it's above the market rent, those leases, for substantially similar places, it's just given to us that it's not just because of that. So we don't have a separate lease. It's going to be a modified contract. Of course, the example has to be the most complex accounting. So once we've determined that it's a modified single contract, we'll note now that there's two separate lease components. This, I think, is where everybody maybe doesn't follow along with the guidance as well, because you say, well, it's one single contract. Why do I now feel like I have two different leases that I'm accounting for? Well, it's two different leased components, that original square foot of space plus the additional right to use that additional space in the 4 years. Again, there's some additional facts with the payments, but you take those lease payments from the modified contract and have to allocate them to the new two lease components on their relative standalone price basis, which we talked about earlier. And this calculation, you'll have to read it a couple times in the example, but you have to think through like your lease years. So there's 5 years left on the original lease, 4 on the additional lease. So it's like 9 lease years left to calculate your lease cost per year to get your allocation for each of the separate lease components. Those total payments will be recognized on a straight line basis over the remaining respective lease terms. So those 5 or 4 years. We have the recognition by year in here, and just in the interest of time as well, I won't walk through these, but it walks through the calculation. I think if you're going through a lease modification, this could be a very helpful tool to kind of see where some of the numbers come from, but also feel free to reach out, because you can see just trying to talk through it, it gets pretty muddy pretty quickly. So our teams are happy to help walk through this. If you have this scenario, and we are always happy to go go through it again and have year 3.5 of presenting on lease accounting, but hopefully the clarification and terminology was helpful today. Again, we discussed some related party lease considerations and that accounting, and then hopefully helped clarify at least another portion of lease modification. I know it will probably not be the last time that we talk about this. I also will note that the public company council, the AICPA, and the FASB are all still looking at options and requesting user and preparer feedback on the leasing standard. I actually sit on a committee of the AICPA that consults with the FASB on issues that private companies have with some of the accounting guidance. And so if you do have any feedback for that, or would be willing to talk with the FASB or with the AICPA directly on your feedback as a either preparer or user of financial statements specifically related to the lease standard, reach out to me. That would be great information, because as you can tell, this is complicated, and sometimes maybe that complication is not always the best, and not providing the most relevant information to financial statement users. So before I introduce our next presenter, we're going to talk, we have code word number 4, which is 331. The next presenter we have is Carrie Mills. I'm going to go ahead and intro her with the code word up, but Carrie Mills is going to join us today to walk through the different types of engagements that KSM offers and highlight the differences in those options. Carrie is a manager in Cat Supper & Miller's Audit and Assurance Services Group. She performs financial statement audits to help ensure clients' accurate financial reporting and assist them with avoiding risk and maximizing efficiencies. She also performs compliance audits to help ensure clients are conforming with the uniform guidance for those that have significant federal award programs. She serves clients in a variety of industries, but she focuses on governmental and not-for-profit entities. Prior to joining KSM, Carrie worked in the attest department at one of Western New York's regional accounting and business consulting firms for over 7 years. We consistently receive questions on the types of engagements that KSM provides and what the differences are there. So we are very happy to have Carrie joining us remotely from New York to help clarify what KSM does.
Thank you, Jessica. And thank you for having me today on the Technically Speaking webinar. So as she mentioned, I'm going to go over the different types of engagements that we offer here at KSM, and I'll also provide more detail on what that deliverable will look like at the end of all of those engagements. This slide provides an overview of the 6 types of engagements that I'll talk about today. The first 3 being over the financial statements, and then there's 3 additional types of engagements that we perform on other information, and I'll go through those in detail as well. So 3 types of engagements that we can perform over a set of financial statements are compilations, reviews, and audits. For a compilation engagement, the report at the end of a compilation does not provide any assurance over the financial statements. This report could also be limited to just 3 pages: the accountant's report, the balance sheet, and the income statement. So this can exclude any disclosures that could be attached to the financial statements, as well as the statement of cash flows. And then there's no independence requirement when you're choosing the firm that does a compilation report. So there's no limitation on who you engage to do that for you. The other 2 types of engagements over financial statements are reviews or audits. And the main difference between those 2 is a review provides limited assurance and an audit provides reasonable assurance. Because both of these types of engagements, the report cannot omit any disclosures to the financial statements, and you do have to choose an accounting firm to perform these engagements that's independent of your organization. And I'll go a little bit more in detail on what these look like. So the objective of a compilation engagement is to collect financial information to assist in presenting information in the form of financial statements on a financial reporting framework. An accountant that performs a compilation is going to obtain knowledge of the entity's financial reporting framework. They'll get your trial balance information and compile those financial statements for you. The accountant doesn't necessarily have to verify or corroborate any of the information that you provide them for a compilation report, but it doesn't mean that they won't perform any procedures during this engagement, because they are required to propose any revisions to the numbers if they are going through and something just doesn't seem right. At the end of a compilation engagement, the accountant's report will need to disclose if there is an independence issue with the company, and then if there were any revisions that we proposed to management that they didn't make. But overall, this is the lowest level of an engagement on financial statements, would take the least amount of time, and again, does not provide with any assurance over the financial statements. The second type of engagement over financial statements is a review. The objective of a review is to provide limited assurance that no material modifications are needed to the financial statements for an applicable financial reporting framework. Now, during a review, the accountant is required to gain knowledge of the entity's industry, and the financial reporting framework that the report is going to be issued on. You'll notice this goes one step further than a compilation, and then there's additional procedures that the accountant will perform when doing a review engagement. So we'll make inquiries of management during the process. We'll require to perform analytical procedures. And then as we're going through those procedures, if anything seems inconsistent with our expectations, we'll also have to perform other procedures wherever necessary to be able to provide that limited assurance report to you at the end of the review engagement. And then before we issue that report for you, we will obtain a letter from management with representations in it that includes the fact that management gave us all the information that we requested to be able to do the review, and that they fulfilled all of their responsibilities over the financial statements. And then as far as communication requirements go at the end of a review, we're required to report if we've found that there's any fraud or non-compliance with applicable laws or regulations with management or those charged with governance. So during our inquiries, we'll ask about those types of things, and we're required to communicate those at the end of a review. And the last type of engagement that we could perform over your financial statements is an audit. Now, the objective of an audit is to provide reasonable assurance about whether the financial statements are free from material misstatement in accordance with an applicable financial reporting framework. Now, what reasonable assurance means is that we'll use sampling and we'll perform a risk assessment to identify transactions that we'll need to look through to be able to provide reasonable assurance, but we don't provide absolute assurance, so we don't look at every transaction that occurs within the company throughout the year. You'll notice the list of procedures that we perform is much more extensive than a review and a compilation. So in order to start the planning process of an audit, we conduct walkthroughs of internal controls. So this takes time up front from both the auditor and the client to go through internal control transactions which occurred, over your cash receipts, cash disbursements. We could look at some payroll transactions, and then we'll also look at the financial reporting process. So how did you come up with those financial statements? After we've performed our risk assessment, we'll do make some inquiries of management. We'll also perform analytical procedures, very similar to what we did in a review, but this will help us as a baseline for conducting additional procedures that we're required to do under an audit because we follow a different set of standards. So we'll do things such as confirm balances with third parties. If you have cash, debt, or accounts receivable, we'll send out those confirmations to get assurance over those balances. And then we'll request some client prepared schedules that support the line items on the financial statements. Again, we'll match up our risk assessment to figure out which ones we should take a deeper look at, but we do use a baseline of the client prepared schedules to get into that detail. And then we'll make our selections. So we'll look at supporting documentation for those accounts based off of a materiality threshold that we calculated. And then also back to the inconsistencies, if there's anything that we find throughout this process, we will need to perform any additional procedures that we deem necessary to be able to provide you with that reasonable assurance. And then at the end of the engagement, before we issue our report, we do get that letter of representation from management that says that all responsibilities were fulfilled and that all information that we requested was provided to us. The communication requirements under an audit are also more extensive than what we have for a review or a compilation. So at the beginning of the audit, during our planning procedures, we come up with a timing and scope of the audit. And then during our risk assessment, we identify if there's any significant risks to look at throughout the audit. We're required to communicate those to management and those charged with governance. So we'll come up with our audit plan and then we'll discuss those. And then as well as when we're going through our procedures, if there's any changes to those significant risks, we have to communicate those throughout the process as well. And then at the end of the audit, we also have some required communications. So we'll communicate our understanding of any significant accounting practices and policies that are applicable to the company, any changes that we've noted from last year to this year, and any new standards that kind of came up throughout the process. We'll also require any significant difficulties if they were encountered throughout the engagement, if we had any difficulties with management throughout the process, anything that hung us up throughout the audit. If we do identify any misstatements, whether they've been corrected as we propose them to management, or even if they're uncorrected, we do provide a schedule of those so that those are documented as well. And then through our inquiries and procedures, if we've identified that there's any fraud or suspicions of fraud or non-compliance with laws or regulations, we need to communicate that as well. And then additionally, as we've gone through the internal control walkthroughs, and if we've tested any of your internal controls, we are required to communicate to you if we've identified any deficiencies that would rise to the level of a material weakness or a significant deficiency. And this is also an opportunity for us if we just identify that there's a best practice that you could incorporate within your organization, anything to help strengthen your internal controls. So it could be something that's a finding, or it could be something that we're just simply providing as an additional service to help you strengthen your internal controls at the end of an audit. So that's an overview of the 3 different types of engagements that we can perform on a set of financial statements. But you still may be wondering, how do I choose which one? Now, there could be internal or external factors that help or make you decide that you need to have one of these done. The first, I'm not going to go over all of them, but the first one is publicly traded company. All publicly traded companies are required to undergo an audit. So if you're considering going public at any time in the future, it might be a good idea to have an audit started so that we can go through, those internal controls, make sure you don't have any findings, and also kind of get you familiar with the audit process prior to actually being required to have one. The second is grant contracts or applications. As Jessica mentioned, I do help perform some of our audits under uniform guidance, which is federal funding for grants. There's specific thresholds that are going to be rising here soon, but if you have $750,000 of federal funding, soon to be $1 million, you are required to have an audit under your financial statements for those grant contracts. And sometimes applications require you to have financial statements to be submitted as well. Now, the level of assurance could change based off of the contract, but you would typically need at least just a set of financial statements compiled to be able to apply for those grants. And then there could be things internal, such as the board just wanting to see a set of financial statements and potentially having some limited or reasonable assurance over them, or management deciding this might be something good for our organization to be able to see and potentially be able to identify some efficiencies in the future. So now that I've gone over the engagements over financial statements, we'll get into examinations. Now, an examination, the objective is to provide reasonable assurance over a subject matter in conformity with certain criteria. So you'll notice that an examination provides very similar assurance as an audit. It's just over different information. So the subject matter included in an examination may be as of a point in time or for a period of time, but it's not over your financial statements. And since we're providing assurance over this subject matter, there is an independence requirement as well. So you will have to keep that in mind as you're selecting a firm to do your examination engagement. On the right-hand side of the slide, you'll see some examples of what an examination engagement could be over. Again, you'll have these slides, so I won't go through all of them. But the first being like listing of costs claimed for reimbursement under a contract or grant. So we could look at those and provide some assurance over the content of those costs claimed. Another example could be looking at your internal controls over financial reporting or compliance. So looking at those internal controls, and again, providing some assurance over what you're actually doing for compliance or reporting. Now, there are 2 different types of examination engagements. The first is an assertion-based engagement. So during an assertion-based exam, a statement is provided by the responsible party over the subject matter, and then we will provide our opinion over that statement as part of our deliverable for this examination. And the second being a direct examination. So this is where the statement is provided the practitioner as we're preparing our report. And these types of examinations are typically over non-financial data. So some examples from the last slide, if we have an examination over your corporate governance characteristics, this would be a direct examination. Throughout an examination engagement, again, some of these procedures may look similar to what we did under an audit, but there are extensive planning procedures that we have to go through, including walkthroughs of internal controls. Now, these walkthroughs would be very targeted to only include the internal controls that you have over the specific criteria that our examination is under, but we still do have to go through all of those planning procedures to provide you with reasonable assurance when we're going through our procedures. We'll make inquiries and perform analytical procedures as well. Depending on the type of information that's included in this engagement, we could confirm balances with third parties. We'll get client prepared schedules and recalculate the data. We could make samples and inspect or observe the evidence as well. If it's over internal controls, we'll reperform the processes or the controls included in there. And then if we see anything that doesn't seem to meet our expectations, we'll also have to perform any additional procedures that we come across to be able to express our opinion at the end of the engagement. And then we will obtain that letter from management representing that they've fulfilled all of their responsibilities. Communication requirements under examination. Sometimes the responsible party and the engaging party for this type of examination can be different. So we do have to communicate any fraud or non-compliance with laws or regulations if we've come across that. If we found any uncorrected misstatements within the information as well, we do need to communicate that. And then if we've identified any deficiencies in internal control related to the specific subject matter, we will communicate that with these parties at the end of the engagement as well. And the next procedure type or engagement type is agreed upon procedures. We can perform an agreed upon procedures on some very specific procedures that have occurred throughout the year. I'll go through some examples, but essentially the report that we provide at the end of an agreed upon procedures engagement does not have an opinion on it. There's no conclusion at all, and it also does not provide you with any assurance. There's also an independence requirement when you are selecting a firm to do an agreed upon procedures for you. And we need to be independent of the party that's responsible for the information that we're doing the agreed upon procedures on. So as I mentioned in the last slide, the responsible party and the engaging party could be different. So the independence requirement lies with the responsible party. But we would perform an agreed upon procedures if you're looking for very targeted or specific results with transactions that have occurred. So some examples of what an agreed upon procedures could look like. We could select a sample of 25 cash disbursements throughout the year just to verify the information within those disbursements. So we would look at, the payee, the address of the payee, the amount that they're getting paid. We'd select those transactions and obtain documentation to support the information that's included in those disbursements. And then we would conclude on whether the information matched at the end of the report. The second example is selecting a sample of bank reconciliations. So we could select, say, 3 months out of the year and look at the bank reconciliations that were performed. Examples of what we could look at is number one, did the bank reconciliations actually get prepared, and did they get reviewed by the responsible person within the company? We would look at the balance that it says that the bank statement should have and obtain the bank statement to make sure that those balances did match. We'd look at the balance of that bank reconciliation and make sure that it matches the general ledger. And then we could also look at the transactions within that bank reconciliation. Did the check it said were outstanding actually clear in the following months? And did the deposits in transit actually clear as well? And then the last example here is we could select a sample of 5 employees and look at what they were paid in a specific pay period, match that to their personnel files, and make sure that it was actually approved by someone who was authorized within the company. So our report at the end of the AUP would be very factual in nature that said, we selected 5 employees and looked at this pay period and matched their personnel or pay rate to the personnel file. So very factual, no opinion. And the last type of engagement that I'm going to go over today is the consulting engagement. So this could be very flexible based off of the needs of the engaging party and whoever's going to use the report at the end of the engagement. We could provide some advice, recommendations, or even just our observations as we looked at some content that you were having us consult on. So some examples of that is we could look at your internal controls and provide some best practices of how you can improve those internal controls, help you develop a process if you don't think that there's something that you have some good enough controls within, and get that manual written. We could look at your IT environment to see if your security is up to what the best practices have for today, or if your board is trying to make a decision, we could weigh in to give you, some pros and cons of making that decision as you're going through that. So revisiting my objectives, I hope today I provided you with enough information on the types of engagements that we offer here at KSM and a little bit more about what the deliverable would look like or the level of assurance that's provided with those engagements. But if you ever have any questions as you're trying to navigate one of these situations, please feel free to reach out to me or anyone else here at KSM, and we would be happy to help you with that.
All right, perfect. Thank you, Carrie. That was great. We get questions all the time about this. And we actually do have a 1-page or maybe it's 2-page resource guide out on the KSM website that walks through this as well. That's a great summary of what Carrie provided today for just a little more context. So as a conclusion to our technical topics today, we're going to move to Brian Fender. First, we have code word number 5, which is 637. I'm going to go ahead and introduce Brian. He's a director in the Audit and Assurances Services Group. He helps clients minimize risk, ensure accurate and complete financial reporting, and maintain compliance with different regulatory institutions. He also advises clients on proper internal controls, policies, and procedures to help them operate more efficiently. His focus is on providing audit, review, and attestation services. So a little bit of everything Carrie just talked about in a wide variety of industries. Brian's going to cover our most recent updates from the Financial Accounting Standards Board today. And hopefully once he's done, you'll be able to discuss those ASUs and kind of what's going on at the FASB level. So without further ado, I'm going to turn it over to Brian Fender.
Thanks, Jessica. Good news and bad news here. Bad news is we're a little bit behind. The good news is I guess I have to cut some of my accounting jokes short. So maybe that's good news for everyone here. I'll save you from those. But yeah, let's go ahead and jump into some new accounting standard updates. So today, again, I'm going to cover accounting standard updates that have been issued by the FASB, specifically those that have been issued since KSM's Q4 webinar we did in November. And then I'm also just going to do some quick reminders on some ASUs which became effective for calendar year 2024 and calendar year 2025, specifically for non-public companies. That will be my focus. So let's move on to some of the new recently issued ASUs. I'm going to gloss over this one quickly, just given where we're on time, specifically just because this one only applies to public business entities. This ASU 2025-01 is really just clarifying the effective date of ASU 2024-03, and really just clarifying that public business entities who have a non-12/31 calendar year end should adopt this standard in a calendar year, not in an interim period. So let's move on to the next slide here on 2024-03 that actually, this all actually relates to. So this standard is all about adding more clarity to the nature of expenses in the income statement. Investors were seeking more granular information on what was included in selling, general, and administrative expenses. Again, this just applies to public business entities. And I'm going to quickly move through the disclosures that are required here. But basically, inventory purchases, compensation, depreciation, things like that. Any of those items that are in expense captions on the income statement and continuing operations, those are required to be disaggregated in this disclosure. And then in addition to this, anything that doesn't get captured by that also needs qualitatively described. And then also there's other requirements to describe, what selling expenses are for an entity, what's their definition. So again, only required for public companies. And the effective date of that, as I previously mentioned, is for annual reporting periods for public business entities after December 15th, 2026, and interim reporting periods within annual reporting periods beginning after December 15th, 2027. And early adoption is permitted here. So moving on here, we'll cover the last new ASU that's been announced since our Q4 presentation. And that's ASU 2024-04 that was issued in November of last year. And this specifically relates to entities that have issued convertible debt. And before I jump into 2024-04, I should really make an important note here and remind everybody that ASU 2020-06, which is also related to convertible debt, is effective for the 2024 calendar year for non-public companies. So that one applies now. And that ASU simplified the accounting approach for convertible instruments by removing this separation of debt and equity components within those instruments. So, and following the issuance of that, stakeholders had some more questions specifically on how to treat the settlement of convertible debt that happens at terms that differ from the original conversion terms, particularly when that relates to convertible debt that has like a cash conversion feature to it. So ASU 2024-04 adds some clarity there and really helps us figure out, does that settlement get accounted for as a debt extinguishment, or does it qualify for an induced conversion accounting? So before I get into what this ASU really changes, I think it's helpful to just recap how an induced conversion is accounted for. That's generally accounted for when you have a settlement of debt and it occurs based on conversion privileges that are changed to induce an early conversion by the holder. And that conversion option they have is only exercisable for a limited period of time. And for an inducement, an entity would recognize inducement expense, and it's really basically the excess consideration they're getting from the inducement over what they would have originally gotten under the original conversion feature. So that results in expense to them. It's really important to note that outcome differs from what would be gain or loss in the income statement from a debt extinguishment. And then it's also important to note that that outcome is going to differ from when perhaps the settlement occurs in the original conversion terms. In that case, there would be no gain or loss in the income statement. So let's take a deeper dive into what this ASU actually changes going forward. So previously, to be an induced conversion, an entity had to issue all the equity securities issuable under the debt's original conversion privileges. So they had to issue all that equity. And then because of that, it really wasn't clear how that requirement would apply when you had these debt instruments with the cash conversion features as well. So it was also unclear how to apply that when there was perhaps addition, modification to, or an elimination of a volume weighted average price formula baked in there. And then it also wasn't clear how that induced conversion guidance would apply to convertible debt that wasn't currently convertible. So to summarize all these changes, now to qualify for induced conversion accounting, that inducement must provide the holder with, at a minimum, the consideration in the same form and amount that was issuable under the conversion privileges provided in the terms of the existing agreement. So in other words, that inducement must provide at a minimum the same form and amount of consideration that was originally available. So I think some examples here make this a little bit easier to follow. One example might be where you had a convertible debt instrument that required the entity to settle the principal in cash, but then allowed that conversion premium to be settled in either cash or shares. So again, cash or shares for that premium, but cash for the principal. So if everything was settled in cash, then that's meeting both the form and amount requirement, and that would be an induced conversion. If it was settled all in cash for the principal and shares, again, that's meeting form and amount under that requirement. That would be an induced conversion. But however, if you had this settled fully in shares, this would not qualify as an induced conversion, and you would instead be looking at a debt extinguishment because specifically the form requirement, the requirement for some of that to be in cash was not met. In a separate example, perhaps that instrument just allows both the principal and the conversion premium to be settled in cash or shares. It doesn't matter. In that case, as long as the amount that is being converted, whether it's cash or it's shares, as long as the amount threshold's met, you're going to end up with an induced conversion there. So moving on here, there's a few more nuances to this. I'll skip over these in the interest of time, but I will just clarify the effective dates here. This is effective for all entities for annual reporting periods beginning after December 15th, 2025. So that would be calendar year 2026. And interim reporting dates within those annual reporting periods, again, calendar year 2026. And early adoption is permitted here as long as the entity has adopted the updates in ASU 2020-06. So moving on here, on the next slide, we have another code word that is 615. Give everyone a few minutes here before I move on. Again, code word 615. All right. So again, 615 one more time, and I will move on to just quickly recap some ASUs that have become effective. So a handful of these on the screen here. I'm not going to go into a lot of detail here, just 5 of them that were effective for non-public companies for this year, 2024. KSM has covered these in our recent webinars. And then I'll move on here to the next slide. For ASUs effective in 2025 for non-public companies. Looks like we have 5 more here. Again, we've covered these recently, so if you have any questions on these and how they might apply to your business, please don't hesitate to reach out to any of our presenters or your KSM advisor. We'd be happy to walk through those with you. So that's all I have today. I appreciate everyone's time, and I will turn it over to Jessica. Thank you.
All right, perfect. Thank you, Brian. I know we were a little bit rushed there at the end. Everybody will have access to these slides. So if you have questions about those ASUs, like Brian mentioned, please be sure to reach out to us, anyone at KSM, any of us listed on the screen here, and we'll help you with those resources that you would need. So I want to thank Ben, Carrie, and Brian for presenting with me today. And thank you to all of you for joining us. I know it's a lot of information in a little bit of time. You have plenty of webinar choices these days, so we appreciate you taking time to be a part of ours. The next Technically Speaking webinar will be on Wednesday, May 14th, 2025. From 11:30 to 1, please save that date. And more information about that with topics and a registration link will be sent in April. We also have in the slides the remainder of the year's schedule for Technically Speaking, so please mark those on your calendar as well. I referred to this earlier in terms of Carrie's presentation. We do have a which engagement scenario is right for your company resource. The link to the webpage for those resource guides is on the slides as well. So we do update this throughout the year, and we're going to add some additional resources there as well. Just as a reminder, if you submitted a question that wasn't answered, or if you have other questions, please reach out to us and we will get back to you. CPE certificates will be emailed out in the next few weeks. If you entered the required amount of code words, please remember to check out of the session before you leave today using the Conferences IO app. If you have any questions, reach out to us or your KSM advisor. Thanks again for joining us today, and we hope that we will see you at our next event. Thank you.